So for today's exercise, we are going to look at the bond market, and specifically we are going to try to look at how a negative interest rate is reflected in the bond market. So I'm going to focus a lot more on scrolling down here and using this price to adjust the price of a theoretical 10-year treasury note that has a face value, as you can see here, of $25.54 and a maturity date of a year from now, or at least a year from this recording. The interest rate currently is set at 2.15%, which results in a price of the bond being $25, an interest rate of roughly 55 cents. Now, again, I want to just emphasize that this is a theoretical bond and this is a very simplified model. So in our simplified model, the price of the bond is the determinant of the interest rate effectively, in the sense that the interest payment is the face value of the bond minus the price. So as we change the price, it will determine the interest by keeping the face value as a constant. In this case, the constant being $25.54. So to show you how this would work, let's say we dropped the price of the bond from $25 and made it instead, let's say $24, right? Just to give it a dramatic change. Now, at $24, we can see that the interest is now increased to $1.64, which is the equivalent of an interest rate of 6.4%. This is how a bond could normally function, right? You would expect that the price going down leads to the interest payment going up, which means that the interest rate is, as we call it, inversely related to the price. That means that as the price goes down, the interest rate increases. So just giving you another example of that, we're going to bring it down to 23, and you will see that now the interest rate is 11.03%. Now, in a negative interest rate environment, appreciate that the face value of the bond is $25.54. In a negative interest rate environment, the price of the bond would be in excess of the face value. So let's say the price of the bond was actually $26. That leads us to a negative 1.78% interest rate, which means that I am paying $26 for a bond that in this case matures, I'm sorry, did I say 1 year? I meant 10 years from now. In this case matures 10 years from now and will require me to pay to the bond issuer 45 cents over that 10-year window. This is how the negative interest rate works with a bond. The bond price, the amount that we're willing to loan or pay, exceeds what the person buying the bond will get back after the bond matures. Clearly, as the bond price goes up, if we were to make it $27, the interest rate would go even further into the negatives. So appreciate the mechanism here, right? Like, if the Federal Reserve was trying to bring down interest rates in the economy to stimulate activity, they would try to purchase more bonds, which would both push cash into the economy, but would also increase the the demand for bonds. So it would shift the demand curve to the right, increasing the demand for bonds. The idea here is that as the demand for bonds increase, if there is not a change in the supply line, then we should expect the price of the bond to go up. Where we don't have a zero lower bound, I could theoretically increase the demand for bonds so much that their price exceeds the face value, which means that the demand for, in this case, a safe asset like the Treasury exceeds the actual value of the bond, the safe asset itself, to the point that people are willing, or buyers, I should say, are willing to hold the bond, regardless of the fact that over that window, they will lose some value of money. There are a few reasons why this could happen. The major one is that some buyers of bonds are required to hold a certain amount of safe assets. So if you are a pension fund in some parts of Europe, you may be required to hold a certain amount of safe assets from the nation that is issuing the bonds that you are that your pension is located in. And because of that, if that issuer is offering negative interest rates, you may be required to still purchase some of those bonds as a proportion of your portfolio, which is why in some cases certain buyers will accept negative interest rates. There could be other reasons as well, but I wanted to illustrate for you more specifically that the demand increasing is what could drive this price up to a point where it exceeds the face value of the bond and create this negative interest rate.